Hey everyone, this is Ricardo Ferreira, Portfolio Manager with Paragon Wealth, back with another episode of Paragon Perspectives, the Long Watch. Everywhere we look, spring is starting to show up again. The grass is getting greener, the trees are blooming, the days are longer, and our CFP John is sneezing like it's an Olympic sport. Spring is supposed to be a season of renewal, when the darkness of the winter starts to fade into the background, and recently, the market seems to be taking that same approach. On March 30th, the market hit the low for the year, falling almost 10% from its most recent high, and it seemed like the news was just getting worse. Oil was rising, the conflict in Iran was escalating, and to top it off, TSA lines at the airport were getting longer. Then, as the market tends to do, it saw the small but glittering light at the end of the tunnel and just started its wall of worry climb back up. As I'm recording this right now, the S&P 500 is only a few points away from an all-time high. It's often said that volatility is the price of admission to the long-term returns of the stock market, and we're reminded of this quite often. In fact, the market typically has pullbacks of 5% to 10% 3 times a year. Yeah, you heard that right. Luckily, as investors, we have short memories. One reason is that the market usually recovers within a month. That's because the market rarely sends an all-clear signal. It just starts moving, usually while investors are still feeling uneasy. This decline felt particularly bad, mainly because there were so many negative headlines that went along with it. And let's be honest, military conflict, rising oil prices, nonstop media coverage, these things have a way of making every market move feel scarier. Most of you are not aggressive investors. You're working hard towards retirement or already retired, so you're not invested solely in stocks. And even if you are only in stocks, you're not invested in just S&P 500 index funds. That's not how we roll around here. Most of you are invested in diversified portfolios made up of individual companies that we believe will help shape and benefit from the economy ahead. Bonds for stability and income, and liquid alternative funds that tend not to correlate either with the bond market or the stock market. And as bad as the S&P 500 performed last quarter, small caps, international stocks, they didn't do as bad. And dividend-paying stocks actually had positive returns last quarter. That's an important reminder during periods of market volatility and stock market recoveries. For all you type A personalities out there, let's bring this back to something that you can relate to: control. What can we control in times like these so we don't make mistakes of selling on emotion and potentially locking in losses? Our process. In the big picture, our process comes down to diversification and quality. We want portfolios to be diversified, but not just for the sake of diversification. We want purposeful diversification. I don't want to put something in the portfolio just because it's different. I want it to complement something else, a zig for a zag, if you will. That's why I pair bonds and certain liquid alternatives. They both have similar risk profiles as it relates to volatility, but because they're not the same asset, they can respond differently to the same catalyst, like a spike in interest rates. When it comes to selecting stocks, we focus on other things that we can control, like quality, durability, and diversification. We want financially strong businesses, durable cash flows, and portfolio of companies that don't all move in the same direction all the time. That is a big part of disciplined long-term investing. A company like Axon Enterprises, which focuses on law enforcement systems and technology, is going to behave much differently than Constellation Brands, which sells beer. It's just the way it's going to be. So why does process matter? Having a process helps a great deal when there's volatility in the market. All of the pieces in the puzzle have a purpose, and they all fit together so that when the going gets tough, we don't just throw out the pieces, because then it becomes much harder to finish the puzzle. The lesson here is not that markets are easy and that we should just be on cruise control, because they're definitely not easy, and we definitely shouldn't. The lesson is that having a disciplined process matters most when headlines are trying to convince you to abandon it. As always, thank you for putting your trust in us. We know how important that is. If you have any questions, you know where to find me in Doylestown. I'm always happy to talk about the markets and the economy, or as my wife calls it, the blah, 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 and the blah, blah, blah. And it gives me a reason to step away from my desk every once in a while. You can also visit our website at paragon-wealth.com and check out our library of articles and videos. Phil's recent one on alternative income tax was a very good one. Until next time, hope you guys have a great one.